TD Cowen has compiled a list of what it calls highest conviction ideas for Canadian stocks. TD says these stocks feed into macro themes such as energy demand and may offer less exposure to cross-border trade. We're joined by Andre-Philippe Hardy, Managing Director, Head of Canadian Research at TD Securities. Thanks very much indeed for joining us.
Thanks for having me, Andrew.
Just give us the broad themes. What is it possible to generalize about changes in the highest conviction list?
Yeah, maybe the best thing to do is start with our macroeconomic perspective, and then it'll become a little more obvious how some of these best ideas came about. So if you look at the Canadian economy right now, it's fairly weak. GDP decline in Q2. We're looking for growth of just above zero in the second half of the year, and somewhere between 1 and 1.5% in 2026. And we expect three key themes to dominate: broadening tariff impacts, we expect more fiscal stimulus, and we expect slowing population growth and mortgage resets. So just quickly on these three items, on tariffs, the Canadian outlook remains clouded by uncertainty around U.S. trade policy, even though it's been 6 months since tariffs were first imposed. Exemptions for USMCA compliant goods have helped cushion the blow, but tariffs on Canadian exports are still rising, and there's a lot of uncertainty around negotiations around the USMCA in 2026. Secondly, on fiscal stimulus, obviously we expect more news today and in October, at which time the federal budget should come out, and that should be positive for many of the companies that we cover. And lastly, there are still some consumer-specific things to be aware of that could be a drag on GDP growth in Canada, and that would be the reduction in the number of temporary residents, as well as a large number of low-rate mortgages that are resetting at higher rates, which is likely to weigh on household spending. So with that backdrop in mind, many of the 25 best ideas we put forward have exposure to supportive macro themes such as energy demand or lower direct exposure to cross-border trade or the Canadian consumer.
Your first idea here, Capital Power, the electricity seller, and focused on Alberta, and Alberta would love to see data centers built.
Yeah, absolutely. So, Capital Power, as you say, is based in Alberta, but it's important to note that they've grown tremendously from their roots as an Alberta-based generator and now have almost 60% of their capacity in the U.S. And we believe Capital Power will benefit from growing demand for electricity while its valuation is the lowest amongst Canadian independent power producers. And there's really three areas of potential growth to note. Alberta data centers, as you note, PJM, which is Pennsylvania, New Jersey, and Maryland, and recontracting in the U.S. So very quickly, starting in Alberta, we do expect significant investments in data center infrastructure, which Capital Power should benefit from both directly and indirectly. That theme of demand for electricity from data center growth is also key in PJM, where Capital Power completed its largest acquisition to date back in June. That area now comprises 18% of Capital Power's net capacity, and there should be very robust load growth over the next decade, in large part driven by data centers. And lastly, the company has upside across its U.S. footprint for contract extensions at premium prices. Capital Power has several U.S. facilities with contracts expiring later in the decade that could be extended in advance.
I was going to jump ahead to a name we haven't heard that much about lately, a very prominent stock though, Gildan Activewear. Why do you see upside in that one?
Yeah, we think the proposed acquisition of Hanesbrands will be positive for the share price and earnings per share growth. Hanesbrands' retail strength and Gildan's industry-leading cost structure create a diversified industry leader capable of market share gains and, in turn, strong growth in EPS and free cash flow. We anticipate upward financial revisions to consensus and for Gildan's multiple gravitating to its historical average. So very quickly on strategy, you now have the U.S. industry leader in printwear and the U.S. industry leader in retail innerwear with complementary product lines and a low-cost structure positioned to gain share in both printwear and retail. And there should be very significant cost synergies as the company implements best-in-class manufacturing, optimizes geographic production and distribution, and vertically integrates some Hanesbrands operations. And there should also be some savings from refinancing debt.
And finally, Boardwalk REIT, the apartment landlord. What in particular attracts you here?
Yeah, our thesis on Boardwalk is that it is in the best markets in terms of fundamentals over the next few years, which is resulting in among the highest forecast growth of any mid to large cap apartment REIT in North America. More specifically, in terms of the market fundamentals, Alberta and Saskatchewan now represent 73% of Boardwalk's operating income, and we like that exposure given relative population growth, less new supply coming on, and lower in-place rents. And financially, Boardwalk has by far the lowest payout ratio of any apartment REIT in Canada. And therefore, Boardwalk is now funding all of its capital expenditures and distributions from operating cash flow, and is the only apartment REIT to do so. Why that's important shows up in the growth that we have seen since 2022 in net asset value, which has been 14% per year, while the rest of the Canadian apartment REITs have been flat. And also we've seen a much faster decline in Boardwalk's leverage than its peers. And despite all the above, Boardwalk still trades in line with Canadian comps. Excuse me.
Andre-Philippe, thank you very much indeed. Andre-Philippe Hardy, Managing Director and Head of Canadian Research at TD Securities.